Look, the key points that we're looking at, global wheat yields last year were above trend, and it resulted in a huge global crop. Even if we just return to trend yields, production is likely to be down in 2014-15, despite an expectation of a larger area being planted to wheat. Consumption of wheat is also likely to fall. Consumption of wheat has been high against shortages of corn and very high corn prices. That has fixed itself with record corn production in the US and a replenishment of stocks. So we are already seeing wheat drop out of feed rations and corn go in. The end result is that global stocks of wheat are likely to continue to grow in 2014-15. And that is actually a theme across most of the grains, or all of the grains, that the world is facing an ongoing replenishment of global stocks of corn, wheat, soybeans, canola. If we're looking at the $8 futures prices for wheat in particular, we are expecting them to fall year on year on the back of that projection of production and consumption. We'll come back to that. And here in New South Wales and Victoria, or Victoria we are today, we'll see a larger year-on-year fall as basis levels return to normal. So the premiums over those US futures markets are likely to drop back as well. I wouldn't stress too much about currency. I don't think it's going to play a particularly large part in the outlook. Canola is going to face larger Canadian stocks and lower demand from the EU. That's the sort of trends that I'm picking up. And soybean production's hitting new record levels. So again, it's that theme of increasing global stocks over that commenced in 2013 and progressing over the next 12 months. So again, we're likely to see canola prices fall year on year to below $500 a tonne in all states. But importantly, that long-term oilseed consumption for crushing is actually growing faster than production, and it's a similar sort of situation with wheat. So we are on a bit of a collision course between production and consumption down the track. Barley prices are likely to be down year on year as well. That's just a continuation of the theme. Now, the outlook for wheat for this year really got set in place with the January 2014 USDA report. There were a few surprises that came through in that report. It confirmed a large crop in 2013, but there's a bit of a saying in the grain industry, big crops keep getting bigger. Well, that's what happened. So it was confirmed as a large crop, but it was confirmed as larger than had previously been thought. We've been talking about a shift of consumption from wheat back to corn, and the extent of that shift was confirmed in that January report, and it was seen as being faster than expected. And that was picked up from the stock levels in the US, where in particular that change was happening, but also from the export numbers for US corn. We had a surge in Chinese buying in August, and there was an expectation that would come back in with a second round of buying. That hasn't happened. Even in the last 10 days, there's been talk of China potentially chasing another couple 100,000 tonne of wheat. That seems to have gone quiet again. But we've got large exportable stocks of wheat from Canada, Australia, EU and Black Sea, and that's put the US exports under pressure in late 2013. So early in the period, US exports were running very strongly, and particularly into Brazil. But as we've progressed through into the end of the year, and it really came out in that January report, there has been competitive pressure put on the US. So even though US wheat prices have been falling, they still haven't captured the extent of exports that people were expecting in that period. So last year, global wheat production hit 712 million tonne on the back of those above average yields. Now, importantly, that was up 15.4 million tonnes on the previous record, and that record was only set in 2011-12. It's actually quite a substantial belting of that previous record in one hit, and only 2 years after it had been set. What I think is fascinating is that even though we've had that massive shift in the goalposts for record production, it only resulted in stocks lifting by 9.3 million tonne. Now, this time last year, we'd sort of been projecting that stocks would tend to go sideways. But that ever-increasing global crop to that massive new record has delivered a surplus. But in my view, it's a relatively modest surplus, a 9.3 million tonne surplus against the level of production that we moved to. Anyway, the confirmation of the trends that had been in place leading into the end of 2013 basically resulted in the price falls extending beyond December, and another round of price falls has hit us in January. My view is that we are probably near the bottom for the time being until we get through the next growing season in the Northern Hemisphere. Either way, the expectation is that there will be further price declines from where we are right now into December 2014, unless the production issues that are just starting to nibble away start to come to fruition. So, for example, we're hearing a little bit about drought in America and a little bit about inadequate snow cover and a little bit about winter kill. And then you read one of the more popular news items on Twitter this morning, and it says in California, they are actually going through their driest patch in 500 years. And, okay, so is that going to extend out into the grain production areas? Just sort of sitting there. Global acreage is up 2.5% is the expectation, but production's likely to fall. So the things to watch are the winter kill in the US. We've had 2 freeze events in January. There will be some damage. Similar in Russia. They're talking about it in Ukraine again this morning. The EU crops haven't really hardened. They've had a fairly soft season, so they haven't really hardened. If they actually get a cold snap, we're likely to see some damage there. And look, we're already getting the doomsdayers talking about El Nino in Australia. So apparently there's a 50% chance of an El Nino developing by August. India is likely to have a big crop, another record crop, and they will remain a net exporter. So one of the changes in the last 3 or 4 years is that India is now sitting there as a regular exporter rather than most years being a net importer. So look, global production, I'm showing a slight decline there. Look, the decline might be greater than that. It might dip down below 700, but we're certainly not likely to see a lift in production at this stage like we had last year. So on the production side of it is going to work in our favour. But on the consumption side, we are expecting that feed use to pull back, and that will help to balance out the drop in production. That's supposed to say, not consumption. Again, we are likely to flatline or go down slightly. There is a bit of a perception that wheat consumption never falls year on year. Well, you can see that it does, and certainly coming off that 11-12 to 12-13, consumption dropped away, and we're expecting it to do it again in the next 12 months. And that is effectively wheat coming out of the feed ration and corn going back in is what's the major driver of that. Long-term trend, of course, is that consumption does lift, and the consumption for human consumption is much more stable. The upward trend is much more stable. Even if production pulls back, the pullback in consumption is likely to deliver a lift in global stocks this year. So that's our best bet expectation. We will get a better view of that by mid-2014. By the time the US is well into their harvest, the Indian harvest will be off, the US harvest will be well underway. We'll have a better idea of what's likely to happen in Europe and the Black Sea. That is when we will get confirmation that yes, there is likely to be a global surplus, or no, things are going to be tight. If the consensus is yes, there is likely to be a global surplus, I think that will trigger the next rundown in prices into our harvest. Again, I emphasise we don't have a really big buffer to play with, though, in terms of the size of the surplus. So we are expecting to see stocks lift. We aren't going to get back to the levels that we had over here, though, but we'll certainly be above 12-13 levels. But we are therefore likely to be looking at the sort of prices we had back here and here maybe, and we don't really want to go there because they're around about $220 a tonne. So I'm not projecting quite that low, but still low. Yeah, so we are expecting a second year in a row of a surplus, and therefore a lift in the global stocks to use ratio from where we are now, and certainly where we were 12 months ago. So that's where the downward bias is likely to come. Now, there's still a very strong correlation between US futures and what we see. It's 84.5% year on year. If we just take the snapshot from end of November to end of November, if we're looking at daily price moves of APW cash prices, there's an 89% correlation with what happens in Australian dollar terms on Chicago. So effectively, where Chicago futures go, Australian prices will head. If we are, US futures were down year on year, and our export-based prices, so this is actually an Adelaide-based price series there. If you are looking at New South Wales, Newcastle zone, they basically flatlined. The average during harvest in New South Wales was the same as it had been the year before. Victoria came in at 280, so down a bit. South Australia came in at 270. And Western Australia has ended up, when you do the conversion, something similar to South Australia. I mean, there's the daily move in futures and APW prices, and you can see that we have the gap between the two is basis levels, and we have actually held quite good basis levels during this last 12-month period. So futures had the biggest impact on year-on-year price moves. The thing about currency is it tends to offset the futures move. So if we get a drop in our dollar, it is often associated with a lift in the US dollar. A lift in the US dollar puts downward pressure on the US dollar commodity price. So it tends to be a bit self-levelling. But the futures tends to outweigh it. At the end of the day, we had a 5-cent drop in the Australian dollar in 2013, and we didn't get higher wheat prices. So people that think, oh yeah, wow, the dollar's dropped by 5 cents, we'll get more for our wheat. The other things actually tend to swamp it. And if you look at the year-on-year move, the drop in futures was in Australian dollars $75. And sure, currency dropped and added 46, but this is my point. The move in futures is tending to outweigh the impact of currency. Basis tends to be a small part of the price anyway, and look, unless we get a drought, basis sort of moves $3 or $4 a tonne. It's not the main mover. So year on year, we ended up with a $24 a tonne drop in the average price at Port Adelaide from 1 year to the next. In Victoria, it was probably about $14 a tonne, and in the Newcastle zone, it was basically zero, because the premium in that market pushed basis levels up to cancel out the impact of the currency and futures. So I guess what I'm saying in the next 12 months is I expect this component to continue to fall. We may well see a weaker dollar, but I don't think it will outweigh the fall in futures, so that we will still get generally a drop in price. And particularly Victorian and New South Wales growers, because of a drop in basis, are more likely to see a price fall, or a larger price fall than, say, South Australia and Western Australia. When we flick over to canola, there's a large crop in Canada. I mean, it's a record crop. It's just a massive crop. And they've got logistics issues. They're not exporting it even as fast as they exported it the year before. There is a big carryover. So in the short term, that has allowed more exports to go out from Australia. And so our canola prices have held up extremely well against falling prices in Canada in particular. But when we start looking at the 2014 crop, we are going to have that hangover of stocks in Canada. There's slowing demand for biofuel, and in the European market, use of rapeseed for biofuel, my understanding is that it peaked in 2010 and it's just come off slightly. It's tending to go sideways. Now, whether a lift in economic growth will turn that around or not sure. But we're certainly not getting the growth in demand for biofuel that we were. So we can expect lower EU demand, particularly if internally they produce a bit more, and particularly if the nearby countries, Poland, Ukraine and so on, lift their production and replace imports from places like Australia. So we've got a rebuilding of the US oilseed stocks, we've got a record Brazilian soybean crop. So it all adds up to an outlook where we can't expect to get the same prices in 12 months' time that we've just had for the harvest just gone. But again, longer term, the global oilseed crush is growing by 15.9% per annum. Production is growing by 13.9% per annum. And there's not there's not that big a buffer between the two. So the gap is closing very rapidly. So unless there is a change in the productivity to lift production, and we are talking about that demand into India and China for these oilseeds. And I think the question was asked, can Canada, if they move to 26 million tonne, can the market absorb that? And the answer from given in the last session was yes, I think so. I would agree with yes, I think so. So I see this demand side continuing to outstrip the production growth over the next period. So this is what's happened to oilseed production in 2013-14, a substantial increase. This is the oilseed crush that I was just talking about. It's the trend growth, and we've had a very solid increase in the last 12 months. So even if we tend to go sideways in the next 12 months, it's still going to remain at very healthy levels. And our global oilseed stocks are being replenished from where they have been over the last 2 years. But, the trend line is pretty flat on those oilseed stocks. So if you start thinking longer term, I think the vision that we got in the last session is pretty similar. Barley prices highly correlated with wheat. I think barley was underpriced during the actual harvest period. Barley prices fell $40 year on year against wheat at 30. Since harvest, so basically during January, we saw wheat prices fall away and barley prices actually rose. So that actually validated the view that barley was too cheap off the header. But we have had some good selling opportunities since harvest. So if we actually look at the harvest averages, I think harvest feed barley will hold up better than the APW. So in other words, the gains that feed barley have already made against wheat, I think will still be in the marketplace when we get to harvest. You can see that our feed barley prices, we think they are pretty low this year, just around about $200 a tonne. And look, Victorian prices, South Australia got to $225 after harvest, Victoria's got to $250. But when you actually look at it, even the 205 or whatever it was average straight off the header is not too bad when you look at it over the last or the previous 5 years. If we look at it against APW, we were at a pretty significant discount. I would have thought a $50 discount is more normal, but coinciding with deregulation of the wheat industry, we actually have seen quite a substantial change in the relativity between feed barley and wheat, and I think we're just going to have to live with that. It's something that's changed the face of it since deregulation. If we're looking at malt, supplies of malt in the global markets right now I think are very good. My understanding is they're good. Our premium during harvest this year has been higher than I expected it to be, and certainly a bit better than the previous 2 years. But my gut feeling is that we're probably going to drop back to a relatively tight $20 a tonne premium for the coming year. So here's the view on potential prices. So this is the average during harvest, so November, December. We averaged 251 with Chicago Board of Trade spot futures. I'm suggesting that we'll drop down to 220. If you actually go back and look at what happened in 2009 and 2011, I think we actually dropped down below that. Our APW price falling from 280 down to 230, so a $50 a tonne price fall. So you can see we are likely to be losing value relative to US futures, so that's the basis being stripped out of it. So these are Geelong prices. If we look at where we are currently, $8 futures, DEC futures for 2014, currently 253 and 267. So that's what I'm saying. If we get through with a reasonable growing season, by the time we get to the middle of the year, pressure will be back on prices, and it will be. I think it will be trying to go from where we are now back down towards that 220, and it will take our cash prices from the 267 we had yesterday back down towards the 230. If you look at the $8 canola futures, look, currently November 2014 futures are 461 in Australian dollars. That's down from 513 average during the harvest we've just had, and I'm saying, look, I think there's a bit more downside on that oilseed price by the time we get to harvest, and that could see canola prices in Victoria go from the 5.10 that they averaged during harvest this year, closer to 4.60, 4.70. The current price in the forward market is 4.95. Feed barley, that's where we averaged in 2013. That's where I think we might be heading, and that's just really a relativity off wheat and the malt barley losing a bit more ground. So feed barley doesn't lose as much ground as wheat does, because it's already picked up some relativity. And then the malt barley, I think, will just be a little bit weaker and in the middle there because of the malt premium dropping back to about $20 a tonne.